Hello.
Okay. So we'll just get started.
Yeah.
You want to start?
Okay. It is something very, very simple. Like, when people talk about covered call and all, they worry a lot. Oh, options are too risky and all. And they are very good tools. So I'll give you some background. I was in London, England, working for a bank by the name Bank of India. And in 1982, the London Trade Option Market, LTOM, they started providing free education in options. And we went there, we attended the course. When I say we, another friend of mine, two of us, we went there and we started learning options. On day one, the instructor, he says, I have done my MBA. He's 28 years old. And thanks to options, because I made so much money in the option market, I was able to complete my MBA. I am from a very poor family. And we were hooked. Myself and my friend, oh my goodness, you can double your money, you can triple your money. So there is no better place at all, right? So we started doing that, buying options when the stock is low, and it is something very simple. You look at, Financial Times, the pink paper, right? Highlight over the weekend on Saturday, highlight the stocks which are 52-week low, right? And then good dividend paying. And then on Monday, instead of buying the stock, you buy the option. And then the stock goes up by $2, option goes up by $1, whatever, you bought at 1 and you are selling at 2, you are doubling your money. So the very first trade I did, my account was with National Westminster Bank. The very first trade I did, within 2 days, we doubled the money. And I was hooked. So we made a lot of money in buying options, selling options, in a very disciplined way. Eventually lost all, a bit more actually, right? But I was single. I was not worried about anybody questioning me, right? So that worked very well. But that gave me the biggest lesson. I realized that buying options, when you buy anything, you pay money, right? When you buy a book, you are paying money. But when you are on the other side, and essentially what happens in the case of options is, you have to get two things right. You have to get the direction of the stock right and the timing. If the stock moves by 50-60%, but within that time frame, you have lost all, right? So we decided, no, we have to be on the other side. We have to be seller of options, right? So it so happened, I came here in 1990 from London, and I joined CIBC. At that time, we were in deep recession already. So for about 4 years, it was bad. If you recall, many of you, it was the worst recession, 4 years. And I got a job in CIBC, paying half of what I was earning in London. So in the evening, I used to work for Source, which is, used to be Radio Shack, and doing vacuuming and all, also selling the stuff, and then also learn taxes. But that was the greatest experience because I learned to live within my means. I also learned taxes, which was very, very important, right? So in the year 2000, so 1990 to 2000, I was working in CIBC in different roles and teaching people across the country, technical subjects, non-technical subjects. Fundamentally, I'm a teacher. And I never thought I'll be in this sort of environment, managing money, right? But I love teaching. So in 2000, I realized that if you are part of the cost center, your job can be dispensed with any time at all. So you have to be on the other side. You have to be profit center, right? And I tried, I had all the industry qualifications. So I talked to everyone. I was selected everywhere. And the only company at that time which understood options was Merrill Lynch. So Merrill Lynch, I joined Merrill Lynch, and that too after 2 years, because they were saying, first of all, you take the book, phone book sort of thing, and start calling people. I said, I cannot, because I have bad accent. I cannot, right? That is one thing, and I can't call 1,000 people and try to get 5 accounts or so. I can't do that. Secondly, you sell mutual funds. I said, no, I can't do that, right? Because I am not answerable for somebody else's decisions, right? So then fortunately I found a person who was a terrific person, vice president at Merrill Lynch. He said, Avin, we do options, we understand options very well, and we will give you complete freedom. You can do whatever you want. We understand covered call strategy, right? And you have freedom to do anything that you want. We will never question you, no target for you, right? So what I did, I had 3 competitive advantages. One is Merrill Lynch brought fee-based accounts here they were successful in US. So I did all the research from Harvard Business School and all. I said, well, this is terrific. They used to call it unlimited advantage. That means, client can contact any time at all for anything, any number of trades, right? I needed a lot of trades for my options, right? So I had that advantage. I had options knowledge. I had fee-based account. And third thing, which was very, very important for me, was teaching. And that is one benefit I had, because if any of you want me to design any seminar in any financial issue, on any financial issue at all, I can do it in 24 hours, get the compliance approval in probably 2-3 days, and present it. I have that confidence. Basically, I'm a teacher. So I started teaching, and I joined Merrill Lynch, and rest is history, because at that time options were not known in the country at all in the year 2000. So now we are in 22 years in the practice. So it has worked very well for us. We are thankful to God, right? And everything has worked only for 2 things, 2 advantages. First is that we had some client base, some people who trusted us. I had a taxation practice, so they said, well, okay, we want to work with you. The second one was options were not known in the country, and we started teaching options. So when I designed the very first seminar on options, I designed on everything, financial planning, you name a thing, on 10-15 different subjects, wills and estate planning. And the best one was covered call writing, because at that time it was still very new, right? So we designed the seminar in plain English, and I'll so that general if I may have any knowledge, I have my master's in mathematics, I have law degree, I have a London banking exam, anything. But if I cannot communicate that to a young person, 10 or 15 years old, in plain English, then I have done nothing. So it is not really worth it. So I started designing the programs which were in plain English. So when I thought about covered call writing, I thought, okay, it is very, very difficult for people to take their thinking around the stocks, indices, and all that. So why shouldn't I start with real estate? Real estate people understand. Now, how many people here own real estate property? Almost more than 50%. How many people own investment real estate? That is your principal residence, you are not worried. Very good, thank you. So, but immediately you find only about, say, 10-15% or maybe 20%. When it is your principal residence, you are not worried. Whether the property prices go up, down, sideways, you have to have a place to live, right? But when it is investment property, you bought for 1 million, goes down in value to 900,000, you worry, right? That is human psychology. So I thought, well, this is the best thing, explain everything in plain English, talk to people in plain English. Because they can relate to real estate, it is much easier for me to teach that concept and then segue that to stock market, right? So that is what I did. So example is this.
So we'll just get to the slide. Do you want to just flip?
Okay.
Yeah.
This is the agenda. Some concept from real estate investing, call options. We'll talk about awareness, liquidity issue. So this is what we'll cover. My only problem is today we have 45 minutes. Mostly my seminar is about 1 hour, 15 minutes, right? And then we stay back, whether it is for 1 hour or 2 hours or 3 hours, we stay back to answer any questions. So today my request is I won't be able to take any questions here, but after the seminar, because of the time constraint, but after the seminar, kindly come to our booth 309 and you can have any questions answered, right? The other thing, before I forget, I wanted everyone to look at this. Richard Ho, which is our top supporter there, he is director for Montreal Exchange. Montreal Exchange is country's option exchange in Canada, right? Options, futures, and he is the director sitting right at the end. Thanks, Richard. So what they have come out with is they want to promote option education in a big way. So they have special prizes. So if you enroll in this program, right, option simulation program, and every week they have $500 prize. At the end of the this contest, they have $10,000. It is real cash. You start working with fake money, but if you work, if you do very well, if you have good results, if you're a top trader, definitely you have that opportunity as well. They say become Canada's top option trader. So kindly take care of this, right? Now coming back to this real estate, the situation is this. What is happening right now? Real estate market is going down. Why? Because interest rates are going up, right? And it is mostly, it works with the interest rate. When the interest rates are very much down, at that time, people feel very comfortable. Take mortgage at 2%, 2.5%. When that, and if they are in variable rate and that 2.5% goes to 5%, they are in trouble, right? So they start looking at, so in our area, for example, we never had any foreclosed property. Right now we have, right? So many people, they cannot pay down their mortgage at all, and they are forced to sell the property or bank possesses the property, right? So the real example here is, let's say you buy a property for $1 million. My real estate agent comes to me and he says, this property was selling for 1.2 million just one year ago. Right now it is in foreclosure and I'll request you to buy it. And he is coming to you, pestering you every single day, buy this property. And you are saying, well, look here, market we do not know. It can go down from 1.2 million to 1 million, it can go down to 800,000, right? So you are undecided. Then he comes to you and he says, look here, you should buy it. This is, I have the feeling that, you will do very well. Then my question is, why don't you buy it if you are so comfortable, right? And the guy says, I am overextended. I have taken 4 or 5 properties, I don't have any money. Bank won't give me any more loan. So I'm fully extended, but I have so much confidence that this property will go back to 1.2 million because interest rates will move up to control inflation and then they will start coming down, right? When they start coming down, real estate will be okay, right? So you'll be fine. The property is going to go back to 1.2 million. And then he is so confident, he says, okay, do one thing. I have 100,000 with me. I don't have anything more. But give me the right of first refusal. You buy the property for $1 million and I can buy the property from you in the next 1 year at 1.1 million. Say, why should I do that? I'll give you money. I'll give you 100,000 because he has that 100,000, right? He does not have anything beyond that. So I'll give you 100,000. His idea is, by giving 100,000, he has the right of first refusal. He can buy the property from you at 1.1 million, and he can sell in the market at 1.2, 1.25, whatever it is, right? So this is a scenario. So in this case, buy the property at 1 million. So I'm buying the property at $1 million. I am immediately selling the right to that real estate agent or any counterparty to buy it in the next 1 year. And for that, selling that right, this is selling the right, I am collecting $100,000. So what I have done here, I have reduced my cost straight away to 900,000. Instead of paying 1 million, right, that is sleep at night factor, 900,000. Now there are only 3 possibilities. Once I buy this property can go up, property can stay sideways, or it can go down, right? Any other possibility? Only 3 possibilities. Same thing in the stock market. Okay, so let's say I bought the property and the property value goes up. As this person expected, the property market starts moving up, right? Interest rate go down again and he is comfortable. So he says, okay, where is my property? 1.1 million. So he has right of first refusal. I cannot sell it to anybody else. So he takes the property. But that time my net cost was 900,000 because I took out 100,000 and he is giving me 1.1 million as per the agreement. So I am making 200,000, 900,000. I am okay with that, right? Not bad. And these numbers may or may not be real. But the thing is, this sort of trading is done in US at private level someplace. Ideally, I wish, we have something like this in Canada and US on stock exchange, maybe on fractional basis, instead of 1 million divided in 100 parts sort of thing, that is not there yet. The second one is nothing happens, the property goes up, down, sideways, but it is below 1.1 million at the end of 1 year, right? Then he has no choice. He won't buy the property which he can buy outside for lower price. He won't buy from you. So essentially you have kept 100,000 and you are free and clear. There is no more any contract, and that time you can play again. You can sell the next right. First right you sold for 100,000, next right in the context of the market you might sell for 80,000, 70,000, anything at all, right? But the whole objective is go on playing that, go on collecting money. The third option is, this is the worst one. You buy back the property, you buy the property and it goes down. You bought for $1 million, and despite all the predictions of this real estate agent or anybody else, the property goes down in value. At that time, and it can be in 2 months, 3 months, 6 months, any time at all. So you go to him, you say, there is no possibility of your buying this property at 1.1 million, right? Because the market has crashed, right? Why would you can buy outside? Why would you buy from me? So free me up of this contract, right, of first refusal. And in that case, he says, why should I do that? Because if you stay till the end of the year, 1 year, you will get nothing, right? But right now I am offering you 20,000 to free me up of the contract, right, of first refusal, right? So he agrees. In that case, what you have done is, you sold something for 100,000, you bought back for 20,000, you made $80,000 in that rights market. And right market is exactly right to buy, or choice, or option. That is, he has, the person, the real estate agent, he has right to buy. He has right to buy for which he has paid you money, $100,000, right? You have on the other side obligation to sell. You cannot sell it to anybody else, right? So that is the difference. So essentially, right to buy means, this person has a choice, he has the option. So essentially, in this context, you are continuously chipping on the price. Whatever price you paid for the property, you are continuously chipping on the price for indefinite period. This is the first example. This is for the people who want to collect more money. Older people who will say, okay, no, we want to have...
Sorry, I'm just going to move to that slide.
Sorry.
So
okay, thanks.
That was the first example.
Yeah, thank you. That was the first example. Yep. Good. Thank you. Oh, Ankit is my son, and he is a CFA, and I have Loy somewhere here, right at the end. Yeah. That is the team we have, right? Yeah. Excellent team. Loy, thank you. So the second example, so first one was where we are collecting large amount of money, $100,000 or whatever. Second example is condo hotel at 1 King Street West, or it can be any place in downtown. So here what is happening in the second case is, we are buying the property for $1 million. Again, same real estate agent comes to you, says, okay, buy the property. And he says, I have tenants for you. Youngsters who want to work in the financial district, right? So they are prepared to pay you $4,500 per month with escalating clause. That means $54,000 in a year. And it is 1 year lease, and then subsequently the rent goes up every year by whatever number, 3%, 4%, anything at all, right? So if you agree to this, it provides you peace of mind, or sleep at night factor. That means, you are not worried because your property is generating cash flow. For the investment property that we talked about, all of us here who are invested in investment property, that is peace of mind. If your property is giving you cash flow every month, that is peace of mind. What it means is you are not in a hurry to sell, right? Market goes down and you, oh, I am collecting rent continuously, right? So you are comfortable with that. So this is what we talk about. Now, what is call option? Right to buy a property. We talked about right to buy a specific stock. Now we are going to segue to stock market, right? So taking you from real estate to stock market. So right to buy a specific property, real estate, or a specific stock or index or ETF at a specific price, $1 million within a certain period. So the person who bought the right, real estate agent, he had the right, he paid you 100,000 to buy the property at 1.1 million specific price within 1 year, right? You're with me? Any question there? Okay. Sorry, I'm not taking any questions. Now I segue to the stock market, right? Ankit, do you want to continue from
Yes.
here?
So just keeping the real estate example in mind, we segue into the stocks, and we specifically chose Apple. It's the trade which we just did about 10 days ago. So we're thinking we'd share the live trade. And the trading that we do is typically done in block. So we'll buy 10,000 shares of Apple, and then we'll allocate to clients based on 100 multiples, because options are in lots of 100 shares. So options are in lots of 100 shares. So after buying 10,000 shares of Apple, we allocated based on the client's investment portfolios. So we may have, let's say, 200 shares in one client's portfolio who may not have exposure to Apple. We may have 100 in another client's portfolio till we've allocated the full block trade that we have done. So Apple, we chose this example because this market has been quite volatile, and Apple still has overall better performance. It's outperforming the tech index as well as the broad-based S&P 500 index. So that's why we chose this example. In the last 52 weeks, the stock's been trading between 129.04 and 182.94. And just yesterday evening, it closed at 150.70.
Now, what happens is, you buy the blue chip stock or the property that we talked about, right? Instead of real estate, you are buying the blue chip stock, which can be Apple, which can be Microsoft, which can be Procter & Gamble, Johnson & Johnson, you name a thing, right? So buy the blue chip stock when you think it is in the buying range, and sell the call option straight away. That is, the option is the choice given to somebody else to buy the stock from you at the same price or higher price. And for selling that right, you are collecting money, right? So exactly like this, you are collecting 100,000 there. So sell the call option, which is, that means, it is essentially that person has the right and you have the obligation to deliver the stock, Apple, to him. So sell the call option to reduce the cost further straight away. You are covered if the stock is called away. Some people will say, okay, we are selling call, right? And they don't have Apple stock. Or in real estate, they go into the contract, collect 100,000, but they don't buy the real estate. In that case, that is called as naked option. In that case, you are losing money. You are covered because if the stock is called, Apple is called, you have Apple to deliver. You have the obligation and you are able to deliver that, right?
So for us, we set price targets on various stocks. For Apple specifically, it came into our buying range. We had a target of 156, but we never pay full price for a stock. So just like the real estate example, we bought the property at 1 million, but we didn't really buy the property at 1 million because we collected $100,000 up front. So same discounted value we take on Apple. We bought the shares of Apple at 156 US dollars per share because it's a US company. And simultaneously, we sold someone the right to take away the Apple shares to be assigned at 160 level by December. So essentially, we're selling an option, selling a call option for December 160 and collecting $8.40 upfront as rental income. We call it rent on stock, or just the premium, which allows us to have.
This is same rental income, the second part.
Yes.
You buy the property, start collecting rent.
Yes. So after buying at 156, we've straight away reduced our cost to 147.60. But what does that option entail? Basically, we are obligated to deliver Apple shares anytime the next 3.5 months because we did this deal on September 9th. So the option expiration is the third week of December for 17th of December. So for about just over 3 months, 3 months and 1 week, we have that obligation to deliver the shares anytime if they're called for. That's why we collected that premium. So again, similar real estate example, the markets, we don't know what they do. We don't have a crystal ball, what happens in the next quarter. But what we do know is if they were to go up, we're making money because our cost after, our cost is 147.60, and we are obligated to sell the shares at 160 if they're called for. And if that happens, we're making $12.40 per share.
Yeah.
on that 147.60 investment. So every holder makes money, even the person who's bought the call option. If the stock goes back to 182 where it was trading in January when Apple was almost a 3 trillion, I think for one day it hit 3 trillion market cap and then it came back after that. But everyone makes money there, but for you, your upside is capped because the maximum profit will be till 160 because we've sold a call option at 160 and we're obligated to deliver the shares at that level. So everyone's happy.
Okay,
That's
I'll
the
just
best
add,
case
so
scenario.
this property goes back to 1.3 million, you have no choice. It goes to 1.2, you have no choice because you have to sell at 1.1 million, right? So that is the restriction, that is, you are capping the upside, that's all.
Right.
Go ahead, please.
So the next case is the more worrisome case. That's if the stock actually goes down, which we've seen right now. After buying at 156, the stock went down. It closed at 150.70. But we're not worried because we know our cost is not 156. We've already taken out a certain level of premium, and we can keep on doing that because that's only for 3 months. Come December or November, we might move those options to March or we might move them to June to continuously chip on our cost. So in between, we don't have to wait for December. We can go into November, and at that time, let's say Apple stock is still trading south of 160. It's trading at 150.70 or around where it's trading right now. That right is no longer as valuable because time has elapsed. And because that time has elapsed, we can go back into the option market and close out that position. So that option, which we had originally sold for $8.40, we might be able to buy it back. Hypothetically, we said $1, just because we're getting very close to that expiration when we're in November. And the overall profit that we make on that trade is $7.40 on the option. So our cost is permanently reduced from 156 minus 740, which is 148.60. The third case scenario is Apple stock. Again, I think a week ago was 163, now it's back to 150, but it stays below 160. If that happens, we permanently captured that income, and we are free and clear in December to sell the next rate. That option is expired, worthless. That's
So
also a
same
good
three
scenario.
scenarios as real estate, up, down, sideways.
Yes.
Come. No question, please. No question. We have 15 minutes. Come to our booth. Any number of questions.
Yes.
We can't.
So although this is best case scenario, if the stock is above 160, if it's called away, you gain $12.40 on a net investment of 147.80, which is 8.4% in just 3.5 months. Plus any dividend in between. If Apple doesn't pay a very high dividend, but we do this with a lot of stocks like Coca-Cola, Procter & Gamble. They pay high dividends. So that's in addition to dividend, a stream of income, which is capital gains income. It's tax preferred. In addition to the dividends to enhance the overall yield on the portfolio. And we also have this downside protection of 5.38% because we've captured this option premium on the initiation of this contract.
Right.
Do you want to continue this part?
Yeah, so I'll take it up from here. What else do the covered call do in addition to what we have talked about? Help in managing taxes in a big way. Year-end tax balancing every year, around 15th of November, we send a note to all our clients. Say, look here, you look at your line 127, now it is 12700, thanks to Revenue Canada. And look at the taxable capital gain, look at, so it is 127. And then you look at line 253, capital losses from the other years, right? Send us that figure for last 3 years because they allow you, in case you had any capital gain on which you paid taxes more than 3 years ago, they allow you only to go back to 3 years to take the money back from the government on the capital gains that you have, the taxes on capital gain that you have already paid. After 3 years, it is gone forever. So we asked them, okay, provide us that information. Also, let us know if there is anything in your tax assessment saying that these are your unrealized capital losses, right? So we work with that, whether they have account only with us or they have at 5 different places, we ask only for information from their tax return. Then at the end of the year, while most of the other people will say, okay, you sell this mutual fund, buy this, right? Year-end tax balancing. Or you sell Royal Bank, buy TD, stay in the same sector. That is no-brainer. In option, you have immense possibilities. You can move the series from December to January, December to June. You can do leaps. You can bring it back from December to October. anything, different series, different, you can have 160, you can have 150, anything, right? So we are able to create losses or gains by doing that strategy to either recover the money from the government, or if there are previous capital losses carry over, then create gains this year, either in stocks or in option. We start with the options first, create gains or losses there to balance the taxes for everyone. Then secondly, partly protecting the embedded gains in stocks. So for example, somebody bought Royal Bank some 20 years ago, and now it's split so many times, the current value, the book value of that comes down to almost $5 or $6, right? And they are worried. They have, say, 10,000 shares after split, right? And their net book value is around 50,000, but their real value, market value, is about 500,000, and they are worried, right? Because if they sell, there is huge tax liability, right? So they don't need to sell, they just go on doing covered call, go on collecting rent on those stocks. They never need to sell. Only at the time of death, that is a different thing. So that is what I cover in my wills and estate planning. I'll talk about that at some other time, right? The third is help in managing our two human emotions of fear and greed, because fear is when the stock fear is when the stock is going down or real estate is going down, you are worried. But if you are collecting rent continuously, you are not worried. I talked about the example too, where you are collecting rent, cash flow every month. So this is, when I designed the seminar, I used the term rent on stocks, and Merrill Lynch compliance said, you cannot use, what is rent on stock? Is it dividend? I said, no, it is over and above dividend. So they approved that, and subsequently they said, well, put a disclaimer in the presentation, this is Avin Mehra's view. So I said, okay, sure, I have no problem with that. It is just for people to understand, right? It is to make it easy for them to understand. Segue from real estate, because real estate most of the people understand, take it to the stock market. Stock indices, whether it's Dow Jones or it is S&P or any, NASDAQ, any of them, it applies to all of them. It applies to so many ETFs, right? In Canada, we are trying to introduce a lot of liquidity, but we are slightly behind. But thanks to Richard, we are making some headway there. Because of that, because of liquidity constraint, and because the bid and ask spread are too high in option market, almost 95% of our book is in US. Unfortunately, hopefully, when the Canadian markets, all of you get involved in option, we'll have 95% here, right? So right now we don't. Then help in managing two human emotions of fear and greed. Greed is, okay, my stock is called away, Apple is called away 160, now it is 180, right? Oh, I sold it too soon because I did covered call, right? So main thing is, it avoids both the emotions, fear when the stock is going down, greed when it is going up. And that is Warren Buffett. Warren Buffett says, okay, you buy when others are, right?
You be greedy when others are fearful.
Right.
Yeah.
Now, question is, why is not everyone doing covered calls? First is lack of knowledge, which we are trying to change, right? And again, thanks to Montreal Exchange. Secondly, market perception that options are risky. They are risky if you are a speculator, not when you are a hedger. So in this one, in the second part, I have attached this complete guide to option selling, right? It is in your packages, where this is from McGraw-Hill. The author says why people, when it is such a simple thing, why people are not doing it? Why people are not doing covered calls, for example? The answer is the old trading axiom, fear and greed. Fear of risk, fear of the unknown, and most important, fear of that which is not understood. Most brokers or investment advisors, when asked about the strategy of option selling, will give a response such as, you want to stay away from that, it is too risky. Option selling cannot be risky. You are reducing your cost. You are hedging, right? So that takes me to this one, options game. Speculators, if you go to the casino, right, you may win 10% of the time. It can be different figure, 10%, 15%, 5%, anything. But most of the time you lose money, you give it to the casino, right? Hedgers, because it is zero-sum game, so hedgers are winning 90% of the time, 10% they are losing out. 10% when the stock goes beyond that, Apple goes to 180, right? Then they are not getting full benefit, right? So if you know this, why you should not be in this? why you should not be continuously a seller, continuously hedger, right? This is that. The other thing I wanted to say is multiple sources of income for covered call. Since you own the stock, whether it is Apple or anything, you are getting dividends. Plus, when we sell Apple or any other stock, we have money sitting in cash. You are earning interest, which is 0.0022%, or I don't know what it is, right? So interest is not much, but you are getting interest income on the idle cash balances. Third is option premium, which is the largest income stream, right? Interestingly, this income stream is capital gains. So only 50% of that is tax. Interest income is taxed at the highest level. If you are in high tax bracket paying 53.2%, you are earning $100, 53.2% you give to Trudeau. Rest stays with you, right? Option premium, only half of your gains are taxed, right? So that is the advantage. That's why we do it. Okay, so now difficult to execute. Unless you are in the market, you are always pitted against professionals in a very thin, illiquid market. We try to overcome this handicap through block trading. That means, we are not buying 100 shares for you or 200 shares for you. We are buying 10,000 shares or we are buying 20,000 shares. So, for example, I think Coke, we have around 39,000 shares at this stage. It is. So over a period of time, you go on adding, and you are comfortable with Procter & Gamble, Coke, or even Microsoft, even though it is down, Apple, even though it is down. But if you are able to collect a lot of premium every 3 months, you have the comfort level, sleep at night factor. So, yeah, and very few professional advisors grasp it or are ready to spend time. So I was ordered, not requested is wrong word. So I was asked by Montreal Exchange to talk to portfolio managers, about 70 of them in a room, and explain the strategy to them, talk to them, try to promote the education amongst the portfolio managers and investor advisors. So I went there and I said, well, look here, this is my presentation, or this is what I am talking about, but there is an offer. Any one of you, if you are interested, come and sit in my office and you can see the process. You cannot see the client account, confidentiality, but you can see the process, right? You know what? Out of 70, not even a single person came. It was free offer, right? So, sorry, Bay Street. So, Bay Street. So strategy afterwards. The strategy may sometimes curtail upside. Beyond covered call, some other option strategies. How are we doing time-wise?
We have about 5 minutes.
Okay. So the put option strategy, put option is on the other side. That is, basically you are paying the premium to protect the downside of the portfolio. So problem is the put option insurance premium. If you have Royal Bank at Procter & Gamble or Apple and you want to protect the downside, option premium is huge. Right? So it is not workable. If you are paying 6% for 6 months, what have you made? Nothing. Right? So that's why, so what we do in callers is, you buy the insurance, buy the put option, and simultaneously sell call option to reduce the cost of insurance. We do that. And normally in our seminar, if you have time and come to Bay Street, we spend a lot of time on this particular slide, talking about different possibilities there, different examples. And currently we are trading weekly options whenever the option premium is reasonable. And then selling or writing, cash covered, selling and writing is same thing. Cash covered puts. So this is the key option strategy used by Warren Buffett. Warren Buffett says options are risky. This is the only strategy which he uses. So he has billions of dollars sitting there, sometimes 150 billion, sometimes 200 billion, and he will say, okay, I don't want to buy Coke at this price, I want to buy at lower price. So he will say, okay, I'm selling put option, insuring somebody else when the Coke goes down, I buy it cheaper, right? And he is just collecting that insurance premium, which is in billions of dollars. So it is that. So in Apple's case, instead of buying the stock at say 156 or so, we can sell on the same day, we can sell the cash covered put at 145, December 145. Yeah, again slightly more than 3 months, 3.5 months, right? for that, we are collecting 545. That means if the stock is actually assigned, because we are insuring, we'll buy the stock, right? So our cost will 145 minus 545. If we don't buy, if the stock stays at above 145, we keep that 545 in our pocket. So that means on 14,500, we are collecting 545 in a short period, right? 3.5 months, which is 3.76% return in less than 3.5 months. This strategy can be used by selling the existing stock position to lock in the gain and then setting up to buy again cheaper by selling put, right? We call it option wheel strategy. That means, you can also do it with the existing portfolio. You have portfolio there with Royal Bank, Procter & Gamble, you name a thing, right? And you are not generating any cash out of that. But by doing this strategy, sell the call options, let the stock be called away, right? Then buy it again, or sell the put option, let the stock be assigned to you, then you start doing covered call, right? That is a strategy. We have books in our booth on option wheel strategy also. Okay. So, our booth 309. It is CIBC booth. Yeah. So writing cash covered put strategy. For this strategy, cash must be set aside in case Apple is assigned.
So these are defensive option strategies. So even for selling puts, we're not selling naked puts. There's always cash secured for that put obligation, just because we have restrictions at CIBC when it comes to using speculative option strategies. So everything is hedging.
Right.
With us, about 20 years, just over 20
We
years.
are doing it for more than 22 years now, right? So you want to talk about this one also?
Yeah, sure.
Yeah, this is very important.
Yeah. So we went through that Apple example. It's the 5th last page in this attachment. You'll actually find different stocks and how we've been trading options. So after buying, for example, we have Apple in here as well at the top, sample option trades. We had bought the shares at $158.50, and then we did the call option by $8, and then we bought back the calls through the life of the contract. So the beauty with this example is it shows that even after buying the stock at $158.50, within the year we've reduced the cost to $139.28, and Apple's been everywhere during that time. So it actually shows the life of the transaction. Eventually the stocks get called away. They may not get called away, in which case sometimes we make a decision, is it worth staying invested in this company? But,
so this system is now automated.
Yes.
That means we immediately know, okay, we bought this stock 1 year ago at this price, and how much we have chipped on the price by doing options. So it is all automated. So that gives peace of mind that, even though we bought the stock and it was all over the map, we have reduced the cost so much. We go on collecting rent, like in the first case, go on collecting rent for indefinite period, right? Some of the books that we have here, which are outside also, this is Bible of option strategy. This is, I think they have 56 different strategies in the book, and if you want to do PhD in options, this is a starting point, right? But my request is, try to understand, nobody in the world can manage your money better than yourself. So education is the most important thing. Come to us, come to any of the people around where you can get education. Educate yourself, that is the most important thing. We are there to help, and definitely, in our booth we have the feedback form which talks about some of the seminars we have, right, on different topics. If you want to add anything more, we want to have specific subject, this one, we'll design the seminar in a matter of 1 day, get the compliance approval, present it to you in 2 to 3 days.
And
right?
we actually have a feedback form. It's the second last page in the seminar package. So if you guys fill that out, and if you leave it at booth 309, there's a chance to win a few Starbucks cards. We have them. We'll be having a draw, and a couple
Books
of
also.
option books as well.
So if you are interested, you can call me, you can call Ankit, and this is all in your package. So you don't have to take picture at all, right? This is the value proposition we have. Our accounts start at, it is for industry, it is not us. Accounts start at 250,000. This is the flat annual fee you pay for, this is discretionary trading. That means, when I started, I had to call for every trade. you know, I want to buy TD Bank, and you know, people are playing golf or whatever, they call in the evening. If TD Bank I am recommending at 70, right, and in the evening it is 72, and why you did not buy for us? Oh, I cannot buy without your approval. If it is 68, did you buy for us? So you could never win. So right now it is all discretionary. That means, you know, when we get the account, we work with you, right, to basically walk with you for a month, 2 months, 3 months, whatever it takes, so that you have comfort level, and then you say, don't call us. We understand what you are doing. We see the reports, how you are reducing the cost. We have explained the concept in plain English, and this is true of all our seminars, whether it is taxation, it is Canadian stock market, US markets, anything at all. Our job is to educate. In the process, we are able to get many clients as well, right? So any questions you have, I am so sorry, but any questions you have, we are at the booth. We can spend any time with you. We have no problem at all, right? And 4:30 we have draw. So fill out the form, right? Feedback form. 4:30 we have draw. Okay. So you win. You know.
Thank you.
Thank you.
Thank you.
Thank you.